Okay, this is the first video for basic managerial accounting concepts. So we're going to talk about some different definitions. We're going to talk about some important language we use in the managerial accounting work that we're going to do. So the big thing you need to understand first and foremost about managerial accounting is that it is separate from financial accounting in that it is mostly utilized inside or internally within an organization and not usually utilized very frequently outside an organization. The real purpose and goal behind managerial accounting is to trace cost elements within the organization to try and find ways to become more efficient, better use of the money within the organization. So you're going to see a lot of tracing and a lot of cost allocation and a lot of those types of things within the realm of managerial accounting. So the first thing that the book talks about is a cost, and a cost is defined as a payment of cash or a commitment to pay cash in the future for the purpose of generating revenues. So it can be either paid now or it can be a promise to pay later, which would create what we call a liability in accounting, but a promise to pay later. But the big part is that the purpose of it is to generate revenue. So it's got to be something we're buying in order to generate revenues. So it doesn't count if it's something that is not for revenues, if it's something external that doesn't have to do with generating revenues. And that usually goes back to whatever the business is in the business of doing, whatever their revenue stream and wherever the revenue stream actually comes from. Costs that are used up in expenses in the production of these revenues are when they have expired. That's when they become what we call expenses. And expenses are the ones you might be more familiar with because expenses are the ones that we actually see on the income statement. And in case we don't remember from the intro class what an income statement is, income is how our income statement is a statement for a period of time. Let's type it here, for a period of time. Statement that shows revenues minus expenses for a given period of time. Okay, so revenue minus expenses for a given period of time is what the income statement does. So a lot of what we're doing here is trying to trace costs, specifically costs that will go and end up on that income statement. Once they have expired or have been incurred, then they become an expense. Revenue, to make sure we're clear on what that is, revenue is how much money we bring in. Okay, revenue is not equal to profit. Revenue is purely money earned in the course of business. Okay, so it has to be earned in the course of whatever the business is in the business to do. So for Walmart, this would be selling things. For a CPA firm, this would be performing tax or audit work or whatever, or consulting work. For a law firm, this would be legal services. For a airline company, this would be fees to fly on the airplane. For a concert company, this would be the ticket sales. So it's all the money coming in. It is not equal to profit, which is a common misconception. Profit really is another name for net income. Profit is after my expenses, revenues minus expenses, but revenue is all the money that's actually generated and coming in. For the purposes of this chapter, where you're going to find most of the time we're talking about revenue, we're going to be talking about some sort of unit price for something that we're selling times the number of units sold. Will usually be how we find our revenue, because we're going to be dealing mostly, at least to begin with manufacturing companies. So if I manufacture staplers, how I know what my revenues are is how many staplers did I sell and how much did I charge for each stapler, and I simply multiply the two to find my total revenue. Now you're going to want to be careful throughout the whole class, really, to pay attention as to whether they are asking for something in total or asking for something per unit. Almost every calculation we do in this book can be done either per unit or in total, but they'll always have to tell you which one they want. They'll say total revenue or revenue per unit, or they'll say, we haven't gone through it yet, but direct costs, in total, or direct cost per unit, or something along those lines. So make sure and pay attention to that. Okay. The next thing the book talks about is a cost object. So a cost object is the object or segment of operations to which costs related for the management's use, such as a product or department. That's a complicated way of saying what drives that cost. Sometimes it's the product, sometimes it's the department, sometimes it's the geographical region. It's however we want to break it down. But whatever is actually driving that cost, what can we attribute that cost to is usually what the cost object ends up being. So again, for a manufacturing company, most of the time it's the product, but you can also attribute it to categories. Let's say you've got a 3-step process in manufacturing something. You could have a department be a cost object, and then it flows through that department into the actual product itself to be a second cost object. All that matters is that we're segmenting and allocating cost to a particular object. Okay. Moving on, accumulating cost. I had that in here. Accumulating cost is the way that costs are measured and recorded. The accounting system typically does this job quite well. When a company receives a phone bill, for example, the bookkeeper records an addition to the telephone expense account and an addition to the liability account accounts payable. So in this way, the cost is accumulated. So every time you receive a phone bill every month, you would add to the total expense for, let's say, a year worth of telephone expense if you're getting a monthly bill. So if you look at this on a personal level outside of a business, if you took your, since the year just ended, if you took your telephone bill and added up everything for the entire year, that would be the accumulation of all of my telephone expense in this case. And the accounting system should do that based on how it is set up to do so. And then assigning costs. Assigning costs is the way that a cost is linked to that cost object, to a cost object. The cost object is something for which the company wants to know the cost. For example, total phone expense, like the one we just talked about, how much was the phone expense for the sales department versus how much was it for manufacturing. And by assigning these costs and finding a method to assign these costs, we can narrow down how much of that expense should be allocated to the sales force versus the manufacturing facility. Okay, next on to direct cost versus indirect cost. So direct cost is cost that can be traced directly to a cost object. So usually real clear path from one to the other. So an example, again, we'll go back to, well, let's go to, let's do a law firm. So a direct cost, to a service product would be the direct labor that lawyer spends their time actually performing those services. For a manufacturing facility, a direct cost, generally we're talking about, if you're manufacturing furniture, it'd be the wood that you use for that furniture would be a direct cost. The labor specifically used to build that piece of furniture would also be a direct cost. Whereas an indirect costs are costs that cannot directly be traced to that object. So let's say I am in that furniture manufacturing facility and I manufacture bookshelves, I manufacture sofas, and I manufacture, let's say, headboards. Those all would have direct costs that we could trace, and how much wood each one used, how much fabric each one used, how much, all those different direct elements that we could trace. But what about the fact they're all made in the same facility? What about the rent or interest expense, depending if you own the property or not, on the facility that they're manufactured? What about the electric bill? How much is each one utilized? Those are indirect costs. And so I cannot directly trace those to a cost object. Instead, what I'm going to do is I'm going to allocate, which is just a fancy word for split up in some logical form or fashion, those costs and put them into kind of little buckets that will show how much each of those products, in my example of 3 products, receives of that indirect cost allocation. Usually some kind of relationship between these two. We usually have to find something that's called a cost driver that drives our decision making in this case. But for sure, you're going to have some method to actually allocate that cost. It's not just going to be, split it 3 ways equally or that kind of thing. Usually there's some methodology behind it. And that's a lot of what we do in this class, is talk about the methodology. So I'm going to end this video there. I prefer to make my videos short, and then I'll continue with the chapter in the next video.